ought to be.
Well, Toastmaster Rebecca Eggleton is accountable. She is a Toastmaster CPA toiling in the trenches with entrepreneurs and business owners. She will provide you the Reader's Digest version of Accounting 101.
Oh, party.
Please give a warm welcome to speaker number one, Toastmaster Rebecca Eggleton. Sorry about that shitty applause.
Thank you. They say money makes the world go round. Well, that's not true. You need a good accountant to make sense of the world. An accountant is what you need. I'm here today to give you a crash course in accounting. And if you're not a business owner, perhaps you're an investor, and I wonder, do you understand those financial statements that you're looking at? So let's just dive right in now to accounting. They say decisions, decisions, decisions. When you start a company, you have a couple decisions to make. Decision number one is the structure. You're going to be a sole proprietor, limited liability company, or a corporation. I'm not going to debate the pros and cons of each, but let's just say that the limited liability company is the preferred option for most people. A limited liability company is attractive. It's not as attractive, though, as our dear Carmelo here. A limited liability company is a flow-through entity. Well, what exactly do I mean by a flow-through entity? So the net income is taxed at the individual level. So that means it flows through the company into the individual or to the partners. So it's only taxed once. Versus a corporation, which is C corporation, that is taxed at the company level, as well as when the dividend is paid, it's taxed at the individual level as dividend income. Nasty. No, no, no. We don't want to have that. So now we come to decision number two. What's your basis of accounting? You can have cash basis or an accrual accounting. Yeah. Cash basis, super simple. Money in, recognize the revenue. Money out, recognize the expense. Very easy. However, the IRS says, hey, if you have revenue more than $26 million, you don't get this choice. And with the exception of maybe Roy here, the rest of us probably are on a cash basis. The accrual basis, however, is you recognize your revenue when it is earned, some criteria on what decides that it's earned, and you recognize the expenses when they are incurred. So it doesn't matter when you receive the money, when you paid it, it's earned and incurred, and it creates the matching principle. So you really actually do get to understand your profitability a little better when you're on the accrual basis, which that's not a cruel trick, that's really how it's done. So we have decision number one, structure, check. Accounting method, check. Onward to the financial statements. All right, you have a balance sheet, an income statement, and a statement of cash flows. And the most important thing about this I want to explain is the equation. This is the fundamental concept. There will be a quiz at the end on this equation. Is assets equal liabilities plus equity. Okay, just so you all remember it, let's practice it together. Assets equal liabilities plus equity. Okay, you should have a handout on your table. You pull that out, which, by the way, this will be the only handout you will receive from me as treasurer. Okay, on your handout you have a balance sheet, you have an income statement, and on the back side you have a statement of cash flows. The balance sheet, you will see, is always as of a certain date. It's as of December 31 in my sample of our Happy Toastmaster LLC. And the income statement is always for a period of time. It's for the year ended or the quarter ended or the month ended. So you'll note I have highlighted on there the asset amount equals at the bottom the liabilities plus the equity. You know you balanced, right? You'll also see on the income statement how the net income at the bottom, the little arrow there, flows into the equity section so that it forms part of the balance sheet. And at the end of the year, the net income will go into your accumulated earnings or your retained earnings, depending if it's an LLC or an S Corp. And it will go to zero, so you can start the next year at zero and you see your total net income for the year. Everybody with me so far? Are we all good? All right. Have I cured anyone's insomnia yet? All right. Last but not least in our concepts is debits and credits. You always hear about those. What the heck are those debits and credits, right? You know? Every transaction has a debit and a credit. Debits must equal credits, otherwise you don't balance, you can't have a balance sheet. The way it works is, on your equation, you have your assets, the other side you have your liabilities and your equities. If you want to increase your assets, you debit. If you want to increase your liabilities, you credit or your equity. Same thing for revenues and expenses. They fall into that equity section. You want to increase your revenues, you credit. You want to increase your expenses, you debit. Yeah. So let's do a quick recap. Think of it as safe accountant, right? So we have S for structure, sole proprietor, limited liability company, corporation. A for accounting method, cash basis or accrual. You have your financial statements, the balance sheet, the income statement, the statement of cash flows, and you have your equation, which here comes the test. Do we remember? Assets equals liabilities plus equity. Awesome. You all pass, and you are all now accountable. Thank you.